Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Stock losses mount as investors face a trio of headwinds from the AI pullback, rising oil prices and mounting bets on a US rate hike. Brent crude, meanwhile, is up more than 4% as Iran and Israel trade strikes, threatening the fragile ceasefire between the US and Tehran. And Intesa Sanpaolo launches a €31 billion bid for Monte de Paschi, just a day after rival Banco BPM proposed its own merger deal. Well, a very good morning. Welcome to Monday. This is the picture in markets. Asian shares dragged down by AI, so catching up to that sell-off on Wall Street on Friday. In Korea, we had seen the Kospi down as much as 8% before trading was halted. It's still down at 6.1%, so pairing some of those earlier losses, but also seeing losses in Taiwan and Japan. So the MSCI Pacific Index down more than 3%. Euro Stoxx 50 futures also down 1.25%. Nasdaq futures managing to carve out some optimism to start the week, up just a touch on S&P E-mini futures as well, but Nasdaq futures up 0.3%. Now flip the board cross asset, and as you can expect, given the geopolitics, Brent is up today by 4.2% at $97 a barrel. You're also looking at the 10-year Treasury yield coming in at 4.57%, so up 4 basis points. Factoring in the geopolitics, as I say, Israel saying that it had struck targets in Iran in retaliation against missile strikes by Tehran. But you've also got traders ramping up bets that the Fed is going to hike rates after Friday's US jobs report. The dollar has been in a tight range. It had been up earlier, given it's the haven of choice through this conflict, just flat to the downside as things stand. Now let's take a look at the risk events on the docket for the week. What have we got? On Wednesday, of course, it's US CPI. Bond traders betting that these numbers will show the biggest surge in consumer prices in years, so adding on the pressure on the Fed to hike. Then on Thursday, we have the ECB rate decision, a hike pretty much nailed on at this point, in traders' minds at least. But is the messaging around that decision going to signal more hikes to come, or will it suggest that this is a hike that's one and done? Then on Thursday, we have the SpaceX IPO pricing. The question being, can Elon Musk persuade investors that the company really is worth $1.75 trillion? An exciting week ahead. Let's set you up for the day and the week ahead. We begin the week with the global tech rout extending into Asia this morning with a circuit breaker earlier in the session for AI bellwether Korea's Kospi. Let's go now to Bloomberg's Winnie Xu in Hong Kong with the latest. Winnie, what are you watching?
Yeah, good morning, Lizzie. It's a pretty bad Monday for Asian stocks today. As you see, the MSCI Asia now down more than 3%. Losses for 3 sessions by now already. And in fact, today it's headed for its biggest intraday loss since March. Now, you can see that there are lots of different factors contributing to these losses. You just mentioned the rising expectation for the Fed to raise rates, and also higher oil prices, as you can see here, amid the geopolitical tensions in the Middle East. And we're also hearing that investors are trimming their existing tech exposure ahead of the SpaceX IPO later this week. Now, you can see that tech-heavy gauges in Japan down more than 3.7%, and also similar moves that we see in the Taiwanese TAIEX index. Overall, we are seeing China's gauges actually doing slightly better, but most key benchmarks in Asia are in fact in the red. Now, you flip the board and take a look at the biggest moves that we see in Asia is still in the South Korean market, with the South Korea's Kospi index earlier down as much as 8%, triggering a trading halt, and now paring back some of those losses, down about 6% right now. We are seeing some retail investors dip buying, along with a bit of a rebound when it comes to Samsung Electronics and SK Hynix. Now, specifically for SK Hynix, we also have NVIDIA's Jensen Huang Trump still in Seoul announcing this partnership with SK Hynix, and also NVIDIA's Jensen Huang mentioning that the tech sell-off that we are seeing right now is in fact a good buying opportunity. And on top of that, we have some earlier comments from President Lee saying that the South Korean's market is in fact still undervalued. So that probably supported a bit of a sentiment. Now, when it comes to the Korean won, we are actually seeing that the won is outperforming Asian peers today, with authorities announcing some new measures to stem the weakness of the won. And also with President Lee saying that the won's weakness is in fact just temporary. Back to you, Lizzie.
Winnie, thank you for the update. That's Bloomberg's Winnie Su in Hong Kong. So as Winnie says, one of the headwinds this morning is AI. Another is the geopolitics. That pushing up oil prices. So let's dive into the geopolitics. The Israel Defense Forces say that it struck what it calls military targets in Iran after the Islamic Republic earlier launched missiles towards Israel. Now, Iranian media are reporting explosions heard in Tehran as well as other cities. And President Trump had urged Israeli Prime Minister Benjamin Netanyahu not to retaliate against the Iranian attacks in a phone call on yesterday. Let's bring in Bloomberg's Horizons Middle East and Africa anchor and Middle East correspondent Abir Abu Omar. She joins us now from the region in Dubai. Abir, good morning. Just talk us through what these tit-for-tat strikes mean really for peace talks more broadly.
Well, good morning, Lizzie. I mean, the peace talks and the ceasefire in general has been fragile since it was reached on April 8th. But the hostilities, or bringing back those hostilities in the region, really puts it at the line. And again, this follows some hostilities that we saw last week where Kuwait in the GCC was attacked we saw attacks against its main airport that saw significant infrastructure damage. But now the return to hostilities between Israel and Iran and Lebanon, Hezbollah in Lebanon, really puts things into questions, right? I mean, the latest that we saw, I'm just seeing these headlines come across the terminal, and it is the fact that IDF has struck several targets in Mashahar petrochemical complex, leading Iranian authorities to evacuate all personnel. So we're seeing the caliber of attacks return to what it started with at the initiation of this war. And bear in mind, we have marked the 100 days since the start of the U.S.-Israeli war against Iran. And so President Trump maintains that the ceasefire negotiations are still underway. He maintains that they are still about to happen. Last week, he was saying that we could see the talks resume by this weekend. Now, we haven't seen that. Iranian counterparts have said that the talks have stalled, and the return to hostilities yet again this morning and into Sunday yesterday don't paint a very positive picture, just like oil markets are reflecting this morning, Lizzie.
Well, exactly. President Trump saying, Abir, that he calls the shots. This is in a Financial Times interview. How is this latest attack going to affect his relationship with Netanyahu?
Yeah, look, I mean, the relationship reportedly has been in tatters over the past few weeks or so, right? It was reported by multiple outlets, including Axios. But also, I mean, President Trump said he got into a call with Benjamin Netanyahu, the Prime Minister of Israel, to say that he should not retaliate by hitting Lebanon or Iran. And what we see happen a few hours later is an Israeli attack, not only against Hezbollah in Lebanon, that's already been ongoing, but against Iran itself, against some Western cities in Iran, including Isfahan, for example. We reported earlier this morning. So the relationship has already been in tatters. A lot of people in Israel are saying that Netanyahu is listening to Trump way too much. You've got Iran hawks or some Israel opposers in the United States saying that President Trump is listening to Benjamin Netanyahu too much and that he's calling the shots. But what we're seeing is definitely two leaders that are not on the same page, especially after those hostilities that we've seen into the early hours of the morning, and what they would mean, Lizzie, for the broader negotiations and certainly the broader region if those attacks were to continue. That is something we'll be keeping an eye on.
Okay, Abir, thank you very much. That's Bloomberg's Abir Abu Omar out of Dubai. Well, as we say, oil is climbing on that escalation in the Middle East. The Strait of Hormuz remaining effectively closed, so choking off crucial energy supplies for global customers. Let's get some analysis now. We can speak to Bloomberg's Anthony De Paula, Middle East energy correspondent. Anthony, good morning. Just talk us through the reaction that we are seeing in the oil price. Brent much higher this morning by 4.5%.
Good morning, Lizzie. Yeah, we're going to see that jump when there is this escalation of tensions, when there are missiles flying around. We are going to see oil react to that. What we've seen is a more muted reaction in the market than some people would have thought based on the closure of the Strait of Hormuz and the amount of oil that's off the market. We haven't seen oil get to $150 or $200 as a lot of people would have thought. And that's because, partly because of the jawboning by the Trump administration trying to talk the price of oil down, and the constant discussion that we've seen from President Trump about saying we're close to a deal, Iran is agreeing to our terms. The market is starting to discount that a little bit, and we are going to see these reactions to escalations in the tensions and to the potential for increased attacks and increased violence there. What's really important is if any additional attacks were to damage production facilities or refining, that would delay even longer the return to market of these important supplies. Other things that have been keeping a lid on the price of oil are a decrease in purchases by China, as they've used a lot of this crude that they have in stockpiles. Other countries in the OECD member nations have put oil on the market, like the U.S., like European countries, like Japan. And we've also seen some oil continuing to trickle out through the Gulf as countries like the UAE, like Saudi Arabia, like Qatar, do put some vessels, crude, jet fuel, naphtha, things like LNG on some tankers and do get them through. So we are seeing these mitigating factors on the market. But as you said, yes, we are going to see these jumps and these spikes as the tensions heighten and as we see new attacks happening before we get that final peace deal, which we continue to wait for, despite the assurances from the Trump administration, Lizzie.
But yes, for all the reasons that you just pointed out, Anthony, President Trump himself over the weekend pointing out that, oil is not where some had warned it could be if the Strait of Hormuz were closed. We're not at $200 a barrel. We're not at $300 a barrel. Meanwhile, we had this OPEC Plus meeting over the weekend. I do wonder how much attention we need to pay to these meetings, these decisions, when even when they hike, it can only be symbolic.
Yeah, Lizzie, well, that's a debate all the time, how much attention we need to pay to OPEC Plus, because a lot of people have said many times that it's past its sell-by date. But OPEC Plus is one of those organizations that still does have a role in stabilizing the market. We saw that during COVID. We saw that after the Russian invasion of Ukraine. And we've seen them really managing the market up through until we did see this war break out in the Middle East. They had been rolling back their quotas, trying to bring more oil back onto the market. That's been blocked now because most of that oil that OPEC Plus can bring back to the market is stuck inside the Persian Gulf. Saudi Arabia is the biggest holder of spare capacity. They've got the biggest capacity to produce oil. They had been doing about 10 million barrels a day before the war. And that's out of a 12.5 million barrel a day capacity. Now they're down much lower. They're exporting probably about 5 only, production somewhere north of 7. So they've had to cut back as well too. But other countries have cut back even more drastically. Iraq, Kuwait, even the UAE has had to cut back. And remember, they left OPEC Plus on May 1st, so they're out of the group. And again, the UAE is one of those countries that has a lot of ability to bring oil back to the market. They are currently increasing capacity, and by leaving OPEC Plus, they're trying to get more of that oil into the market now. But what this signal from OPEC Plus is that once Hormuz opens, they're not going to put the brakes on the countries, on those members, of getting that oil back into the market. They're going to allow that production to flow as much as it can. There is going to be a lag of those countries getting production back to the market, and that's going to be key for how quickly we do recover. So we're going to be watching that to see when Hormuz opens and how quickly those barrels come back, Lizzie.
Yes. Bloomberg's Anthony DePaola, thank you very much for that update. We're still ahead right here on Daybreak Europe. As London Tech Week gets underway today, we'll be discussing the next wave of UK AI with Carolyn Dawson, CEO of Founders Forum Group. But first, Fed officials grappling with inflation pressure from the Middle East and a hot jobs number for May. So we'll discuss that next. This is Bloomberg.
The message from the labor market is your steady state break-even pace, so the pace that you can go without really generating inflation in a big way, is probably in the 70-ish thousand range, which is likely where the trend in payrolls is actually settling.
The facts that are changing here is a stronger labor market, a fourth supply-side shock in the form of the war, and its impact on oil inflation. And absolutely, we've changed the narrative that's already been in the price. It's going to continue, as you're seeing in the markets here today.
If you've got an economy that's doing quite well, you've got an AI, you've got a big cylinder of AI that you see show up in construction, and you see that what companies are doing that are starting to implement. So, you know, and I think you got to think about the Fed's reaction function. The data so far is solid, and you got to build that into your positioning.
Some of our guests from across Bloomberg TV reacting to Friday's hotter than expected jobs report. And that payrolls print has fueled expectations that the Fed could be forced to hike rates in the coming months as Kevin Warsh prepares for his first meeting as Fed chair. President Trump pushed back, though, on the idea of a hike this weekend in an interview with NBC.
Nowadays, when you have good reports, the market goes down because they think they're going to raise interest rates. There's no reason to raise interest rates. I don't want to kill success. We should actually lower interest rates. Now, I would like to see rates get lower because we could build this into the greatest machine that the world has ever seen. But you can't do that when everybody immediately raises interest rates.
Let's bring in Bloomberg MLive strategist Mark Cudmore now. So, Mark, nothing new from the president there, but is a hike looking inevitable at this point from the Fed this year?
Not inevitable, but it's certainly we've priced more a hike this year as it's more than 100% priced. But of course, that's a probability distributed kind of slew of outcomes, and there are some people in the market who still think that we might even get a cut. Myself, I think it's impossible we can cut in this market, but I see the Fed trying to hold for as long as possible until they're forced into a hike. The problem is that with the jobs data strong, the price data really accelerating away, they might be forced into that corner. So I won't say it's inevitable yet, but I think we're going into a world where people are starting to realize that it may be the outcome. Now, one of the things to consider is that if we get one hike, we might be on multiple hikes because they're not going to do it until they're absolutely forced, which means they'll be behind the curve when they finally do hike. So I almost think that the choice is between hold or multiple hikes.
And when we get the CPI print out of the US on Wednesday, is it likely that that just makes it even more likely that we get a hike from the Fed this year?
Yeah, that's the problem. The consensus forecast is 4.2% for the headline number. Inflation at above 4% is just too problematic, particularly in a year of midterm elections. And I think it's going to be very hard for people to ignore. So it's just going to change the whole narrative. So, yeah, absolutely. I think, the market, it feels that the Fed, will be kind of boxed into, be forced to make a move higher probably before year end. Not imminently. The Fed meeting this month, will likely just be a hold, will likely kind of buy time. They're hoping to look through it. They're hoping that there's going to be a peace deal in the Iran conflict, which will see oil prices collapse, which will help provide a disinflationary wave. But if we don't get that very soon, there's only one way this can go. But I do reiterate, I think the choice really is between a hold or multiple hikes. It's not just whether we get a token hike.
OK, really interesting. Mark Cudmore, Bloomberg MLive strategist there. And that is, of course, in contrast to what some are saying about the ECB, that it could be one and done for them. That according to the likes of JP Morgan Asset Management and Pictet. Well, now let's turn to some other top stories we're following for you around the world this morning. European leaders are urging Vladimir Putin to agree to an immediate ceasefire with Ukraine and begin talks on a lasting peace deal. Britain, Germany and France made the call after meeting Ukrainian President Volodymyr Zelensky in London, where they discussed conditions for ending the war. The appeal comes after Putin rejected Kyiv's ceasefire proposal last week, with fighting intensifying over the weekend. And an exclusive UK poll for Bloomberg shows that a new Brexit referendum would reverse the vote that led to Britain's departure from the European Union a decade ago. 52% of the British population think that the UK should rejoin the EU, according to the survey. Only 33% said the UK should remain outside the EU. Younger voters overwhelmingly favour reversing Brexit, whereas half of those ages 55 and above oppose returning to the bloc. Well, those are some of our top stories from around the world this morning. But coming up on the show, a new phase of deal-making is on the cards in Italian finance, with 2 rival bids in 2 days for the world's oldest bank. The latest is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:25 a.m. here in London. Now to Italian banking. Intesa Sanpaolo has offered to buy Monte Paschi for €30.6 billion, just one day after a rival pitch from Banco BPM. Now the moves are likely to spur a new phase in deal-making in Italian finance. So let's get some analysis now. We can speak to Bloomberg's deals reporter, Manuel Baigorri. Good morning, Manuel. More consolidation, it looks like, in the Italian banking sector. Why is Intesa making this move, and what are the hurdles likely to be?
Yes, Lizzie, another day, another deal, and here it comes Italy again, the financial sector spurring a wave of deal making. We've seen the banks in Italy and the insurers moving really fast when it comes to deal making. We've seen a lot of moves in the last couple of years, and here's the latest to keep us busy over the weekend with Intesa making a bid that is going to compete with another proposal, right, from BPM as well. So far, few details from each side. The one over the weekend from BPM just stated very vaguely that the combination of the two would create an institution with more than 50 billion euros in market cap, but no further details. The one from Intesa that just happened today has a little bit more detail in it. It clearly states that it's a combination of cash and shares, and that it also agreed to sell the brand and part of the branches to Italian insurer Unipol as well. So it's a little bit more specific, but this is all very early stages. And as we've seen in Italian finance in the past, these deals tend to take quite a few twists and turns. So I think we are here for one more kind of like, or several more episodes on this potential saga for what is the oldest bank in Italy right there.
Yeah, of course, and interesting to note that. And also the fact that UniCredit unsuccessfully tried to buy Banco BPM. So this is a big web of potential consolidation. But what do we know about how the two bids compare, Banco BPM's own bid and Intesa's bid for Monte Paschi?
Yes, definitely very little as of now. The one from Intesa, Lizzie, is much more detailed. It's definitely clearly said that it's a combo of shares and cash. So it will remain to be seen how investors value that proposal. They also mentioned the agreement with Unipol, the insurer, to sell Paschi's brand and about half the branches as well. But the one from BPN, though, it's very, very thin in details. They just made a proposal to potentially combine the two. Which one is reacting to which remains to be seen, and which one has done more legwork with the other side will be critical here.
Yeah. Manuel, thank you very much. We'll watch them all at the Open. Manuel Baigorri there. Plenty more coming up. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Stock losses mount as investors face a trio of headwinds from the AI pullback, rising oil prices and mounting bets on a US rate hike. Crude is up more than 4% for Brent as Iran and Israel trade strikes, the latest blow to the fragile ceasefire between Washington and Tehran. And Intesa Sanpaolo launches a €31 billion bid for Monte de Paschi, just a day after rival Banco BPM proposed its own merger deal. Well, a very good morning. Welcome to the show if you're just joining us, 6:30 a.m. here in London. And your markets look like this Monday morning. We've got Asian shares dragged down by AI, so catching up to the sell-off on Wall Street on Friday. In Korea, we had seen losses of some 8% on the Kospi. So pairing some of that now, you're looking at the Kospi currently down 6.6%, but also seeing losses in Taiwan and Japan. Euro Stoxx 50 futures pointing to a lower open as well, down 1.4%. And S&P E-mini futures flat as a pancake as things stand. But take a look at Nasdaq futures, up 0.2%. So managing to carve out some optimism to start a new week. Now, flip the board over to the cross-asset picture. And we have seen the geopolitics reflected in the oil price this morning, up 4.4% at $97.20 a barrel for Brent. This on Israel saying that it had struck targets in Iran in retaliation against missile attacks by Tehran. That lifting yield, so on the 10-year, we're now at 4.56%, up 4 basis points. You've also got traders ramping up bets the Fed's going to hike after Friday's US jobs report. And now, as Mark Cudmore flagged, we have to look to the CPI report on Wednesday. And the dollar has been higher again on the geopolitics. Of course, it is the haven of choice through this conflict. But currently, the Bloomberg Dollar Spot Index just now flat to the downside. Let's take a look at your front pages as well this morning. We'll kick off with the Financial Times today. They're leading with those Israeli and Iranian strikes overnight, saying that the action's testing Iran's truce with the US. The Middle East also leading the Wall Street Journal, which says that Israel's Benjamin Netanyahu launched a counter-assault despite pleas from President Trump to avoid escalation. And if we turn here in Europe to Italy's Corriere della Sera, they've got the latest talks over Ukraine, those happening in London. And the headline describes European leaders setting out 5 points for peace and Ukraine's President Zelensky calling for a freeze to the front line. So a lot of geopolitics on the front pages this morning, but you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which, as ever, terminal subscribers can find by going to DAYB Go. Now let's turn back to the markets. The European Central Bank will likely hike rates this week as the economy continues to suffer from oil shocks. Bloomberg Economics believes that the ECB will almost certainly raise borrowing costs by 25 basis points, bringing the deposit rate to 2.25%. Well, joining me now for more is Lauren van Biljon, Senior Portfolio Manager at Allspring Global Investments. Good to see you, Lauren. We're matching in green this morning. I think this is a green light to the ECB hiking rates on Thursday, but interesting to see that you don't think there'll be many more hikes after this. One and done is your view, I think.
Well, definitely one. I agree with that. And certainly a good chance of a second. What I don't think we're in for is sort of a longer series of rate hikes, particularly into next year. I just don't think the sort of macro setup is there for that.
OK, and so it's more because of the growth risks than because you're optimistic that the Iran war is going to end soon?
Well, certainly the headlines this morning don't make us wildly optimistic on a very short-term solution to Iran. But I think that is a key component. So we've had this one energy price shock. If that does persist and it does continue and it gets a little bit more awkwardly into inflation expectations, that raises the risks of the ECB and all central banks having to do more. But I think particularly in Europe, yes, there's this downside growth risk. And we're starting to see it play out. The last round of PMIs I thought were really interesting because, yes, manufacturing PMIs were much higher on input prices, but services PMIs are certainly softening, particularly in Europe. And we do need to, at some point the market does need to think beyond these short-term inflation numbers and think about that longer-term growth number. So I think if the ECB can do one or two sort of insurance hikes, that sort of probably gives them enough to pause and reconsider for a good length of time.
So if the messaging from President Lagarde and co isn't as hawkish as expected this week, how much could we see yields dropping? Like, would you want to be long 2-year bunts heading into Thursday's meeting?
Well, I suppose, quite frankly, we are long 2-year bunts heading into Thursday's meeting already. We've been using this whole conflict as an opportunity to sort of up European exposure, to add a little bit of duration. Just thinking about that sort of 6-month horizon and where we think things will be. And the key for that Thursday meeting is going to be the scenarios that and the staff projections that we see playing out. Just how adverse does that adverse scenario start to look? And where is that consensus within the ECB? Because, like you say, with 10-year bonds at north of 3%, again, given that longer-term macro framework, to us that's pretty attractive.
And how vulnerable is the euro then to weaker growth data as well?
Yeah, that's an interesting one because on the valuation side of things, the euro is pretty fairly valued. Currency markets, like a lot of the undervaluation sits in Asia at present. But it's been really difficult to unlock that undervaluation in any sort of sustainable way. And I think until we see some sort of lasting peace out of the Middle East, that's probably true. That probably remains true. So the euro doesn't have a lot of valuation behind it. Fundamentals, you would say, are probably weakening. So you kind of end up leaning on that technical side for a lot of the market. I think I'd be biased for that euro to weaken, at least into any sort of peace deal, and then maybe we reconsider.
OK. Let's also just think about the US data, because, of course, we had the jobs report Friday and stronger than expected payrolls numbers. Is it inevitable that the Fed is going to hike this year? I was just speaking to our colleague Mark Cudmore, and he was saying that they'll try and hold for as long as possible.
Absolutely. No, I don't think it's inevitable, but it's obviously going to be a very discussed topic. I think they will. I think that bias is to hold. And yes, that Friday data was stronger than expected. But I think if you look under the hood of that, there's 2 bits I thought that were really interesting. One is that wage pressure didn't accelerate. Right, wage growth was steady from the previous number. I think that's important. If we're not seeing wage acceleration, I think that makes it much easier for the Fed to look through these numbers. And I think the second aspect that was really interesting, that a lot of the ads came in leisure and hospitality. We know going into the World Cup that there is going to be hiring, but it probably will be pretty temporary in nature. We might be seeing sort of a bit of an anomaly here before we go into a much calmer, quieter summer, at least on the jobs creation front for the US. So an interesting report, but I don't think this sort of knockout in terms of policy pricing that some are making it out to be.
OK. Lauren, great to see you this Monday morning. Thanks for doing the early shift for us. That's Lauren van Biljon, Senior Portfolio Manager at Allspring Global Investments, as we look ahead to that US CPI print on Wednesday. Well, I just wanted to check in on these markets because we have seen some dramatic moves out of Korea this morning. Trading had been halted earlier on the Kospi. Now we're seeing South Korea's Kosdaq sinking 8% and that triggering a circuit breaker. The Kosdaq trading halted for 20 minutes as a result. You've got the Kospi now down 7.3% and that dragging Asia as a whole lower. MSCI Pacific Asia Index down 3.4%, but also seeing losses of more than 4% on the Nikkei. The Topix down 3%, and Taiwan's TAIEX Index, I think, down 3.3% as things stand. So some pretty dramatic moves here as that negativity around AI from Wall Street on Friday continues into into a new week. We'd already seen losses on the Nasdaq, even if they're set to turn around this morning. In fact, the Nasdaq is now lower just a couple of basis points, so erasing the gains that were set to come earlier on. We're also seeing some pretty dramatic moves when it comes to oil. So just a few moments ago, you had seen Brent extending its advance on these Israel-Iran attacks, going both ways and going up more than 5%. We are now up 4.8% at $97.52 a barrel. So plenty of market action. Two key tailwinds this morning, the AI story, but also the geopolitics. And coming up on the programme, we're going to get an insight into the state of the UK tech sector with the CEO of Founders Forum Group, Carolyn, Dawson. We'll see how the AI story is playing out here in the UK. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:43 a.m. here in London. Well, London Tech Week kicks off today with leaders in technology and business gathering here in the British capital. Tech Nation's latest report on the next wave of UK AI breaks down the state of the tech sector. And Bloomberg's Tom Mackenzie's with us with all the details. Tom.
Well, details that I've taken from this Tech Nation report, I should say, of course, Lizzie, as you said. And this is a really big week, of course, for UK tech and everything that's happening within AI. We've got London Tech Week, we've got Founders Forum, and we're going to be speaking to the head and the CEO of the group that is overseeing those events shortly. But in terms of the numbers, just to kind of set size and scale at this moment, we'll be thinking about these huge historic IPOs in the US. The UK is playing its part. And in terms of market valuation right now, again, according to the Tech Nation report, we're looking at $1.6 trillion overall in terms of the UK tech sector right now. AI is very much front and centre, makes up about a third of that in terms of the overall pie. So you can see that chart showing total UK tech, that's the blue line, and then UK AI is the pink line. In terms of AI and its role, again, overall, that AI component, that's the pink line. In terms of venture capital investments, you can see that moving higher, even as the overall picture in terms of VC investment has slowed to some extent. Some really big numbers in terms of AI investment, about $11 billion US just in the first half has flowed into UK AI firms. Again, in terms of size and scale, we have another chart that's showing what is happening more broadly. Of course, the UK has its strengths around things like biopharma and defence. There's an expectation that maybe that expands further from here as well. You have names, of course, like 11 Labs, like Synthesia, that have raised significant capital. 11 Labs quite recently. You've got Wave AI, of course, as well. More than 680 AI startups launched alone just in 2025. Wow. Again, on the sectors front, finance, pharma, biotech. In terms of the potential downsides and risks for the UK, it's the dependence not just on US capital, and you can see how much money flows back in terms of venture capital money invested flowing back after an exit to the US, but also being built, a lot of these companies being built on Frontier Labs, of course, US Frontier Labs. But in terms of talent, we also have that, about 57,000 workforce and about 10,000 AI researchers as well. So that is a bit of context in terms of where the UK sits. For more on this, then, let's bring in Carolyn Dawson, who is CEO of Founders Forum Group and, of course, behind Tech Nation as well, CEO of Tech Nation as well. Carolyn, I've run through some of the numbers there, so you have your finger on the pulse of the UK tech sector and, of course, UK AI on a huge week for the UK as we focus on London Tech Week and Founders Forum. What is the current health of this UK ecosystem? I've run through some of the numbers. Put that into the context for us.
It feels really good as we enter this week. I think we've talked about numbers a lot in the past. We know that the UK is leading for AI and now I think across for the tech sector. But I think what we're matching now is real momentum with that ambition that has been stated in the past. And you're starting to see real cases and proof points. You mentioned 11 Labs, but we have Synthesia, Granola, Wave, all sitting behind these. These are just fantastic growth stories. You talked about that funding. But I think for us now in the UK, we're in a position where we have not only leading positions in research and AI workforces, building fantastic companies here, but also have the potential to see that real adoption across enterprises and public sector in AI. So all of the ingredients for a phenomenal momentum in the tech sector.
And we've name-checked some of the key names in the UK AI ecosystem. Are you confident, how confident are you and the team that we're getting to the point where we can have globally scalable UK tech companies that will globally scale and have that impact?
I feel that we've got a great amount of confidence in that, especially you're seeing it. We're growing at twice the rate of European companies. We are seeing that all the capital that's coming into the UK, all of those ingredients are absolutely front and centre. So there is every confidence, I think, that we have all the ingredients to make it good. I think now what we are asking for, what we're hearing the founders ask for from government, is that we really focus on what are the tax incentives, what are the incentives around talent, and what can we do about energy and infrastructure to ensure that we stay ahead. Let's not be complacent as we get into the week that's London Tech Week.
Well, as we think about who that next government might be, of course, there's so much political speculation at the moment that it could be Andy Burnham, the Mayor of Greater Manchester, and he's been saying that if he were PM, Carolyn, he'd increase regulation on tech companies. I'm sure that's not music to your ears. Would more regulation of UK tech be totally a bad thing? Is there anything that you would actually welcome?
I think the startups in our report have actually asked for, I think a review around AI safety. So you can't ignore it, can't ignore the regulation. But actually, I think the UK is poised ahead of its European counterparts to get that balance right between openness, security and innovation. And that is something that we should really stay alive to. So I think we do need to make sure that balance is there. Look, I think whoever is in Westminster, we need to make sure that we've got a government that's pro-business, pro-scale-up policies. We have so much potential now for the tech ecosystem, and I think the government recognises that tech has got a really critical part to play in that economic growth. So let's make sure we don't strangle that.
I mean, we've been, both Tom and I, to Founders Forum and London Tech Week for a few years now, but I feel like there's a real conversation that's been hotting up more recently about jobs being displaced by AI and what the government should be doing about that. Do you feel like that might be some sort of elephant in the room this year? Like, what do you think leaders should be saying about what to do about those jobs? Because, yes, AI may create jobs, but it's not necessarily the same jobs that are being displaced. What should the government's role be?
No, and you'll see announcements this morning from the Prime Minister about what they're thinking through in terms of AI skills and looking to support companies as they're thinking about the kind of reskilling that might be required, for sure. It's still very early days in the AI journey. I mean, we're seeing that actually founders are sort of calling out that there has been a very small number of redundancies due to it. And actually, at the moment, the opportunity is greater than the negatives. But we'll also see an AI adoption event happening today, which is actually really focusing between government and enterprises about where are they adopting it, where are we seeing productivity, where are we seeing efficiencies, and what can we then do about that reskilling component of it. So I think it's very much going to be front and centre the topic of discussion this week, as well as actually the adoption and what else can we do to, I think, motivate these companies to grow, build and scale their businesses here in the UK.
Are you concerned that we're overly dependent on US tech, and particularly US Frontier Lab? With Frontier Labs, we do not have our own Frontier Lab. We got DeepMind, but it's owned by Alphabet. Is that how much of a potential risk to the growth that we're seeing is that?
I think every economy is asking itself that question now about how much they truly have around their own digital sovereignty. But actually, there have been some brilliant pieces over the weekend just saying no country truly has 100% digital sovereignty. And I think we can't think about ourselves just in isolation. The fact is, 30% of the founders that we have in AI companies in the UK say they wouldn't exist if it weren't for actually some of those LLMs that they're building their companies on. So it really comes down to actually working together and not working in silos and making sure that we have a very, very strong position in the stack. So let's look at, again, we're seeing signals from government about buying UK chip companies. We have Fractal, we have Olix who are developing real capability. So let's look at that blend of domestic capability, but not shutting ourselves off to international cutting edge technology. It needs to be a balance of both.
How much of a constraint are data centres, AI infrastructure and energy costs?
It's critical. It's critical. So I think that energy infrastructure conversation, again, needs to be front and centre this week. Founders are calling out for that, as well as the sort of the tax incentives that they might require. We're getting, I think there's two clear call-outs. One is to expand the EMI scheme, which I think is critical for us to enable to attract the best talent we can into the UK, and that's another kind of thing that we're really calling out. The second is for repeat entrepreneurs relief. We're now getting a really good maturing ecosystem here, and it's a huge thing to celebrate this week during London Tech Week. But we've got many exited founders. Let's incentivise more of them to grow and scale again.
Okay, Carolyn, it's an exciting week ahead for you. Carolyn Dawson, CEO of Founders Forum Group. And our coverage of London Tech Week does continue. We'll be speaking to Judith Dada, General Partner at Visionaries. We'll have Ewan Blair, CEO and founder of Multiverse on. Kanishka Narayan, UK Minister for AI and Online Safety. And Sikandar Rashid, Global Head of AI Infrastructure and Head of Europe over at Brookfield. So Tom is going to be a busy man this week. That was also Tom McKenzie. Now, the challenges of the Middle East conflict is currently a hot topic for airline industry bosses. The CEO of British Airways owner IAG joined Bloomberg's Guy Johnson at the IATA annual meeting over in Rio de Janeiro. They also discussed why Europe's rethinking its approach to consolidation. Let's take a listen.
I think we are taking advantage in some routes that now the people they cannot fly through the Middle East. Yep. We put more capacity to some destinations from London in Asia, but I think it's something that is going to finish soon. I think as soon as the Gulf carriers
so it's
recover.
Not structural.
No, I don't think so.
No.
I think some of them they are flying now 80% of the capacity they were flying previously, and I think we are not going to have a structural change.
Do you see a price war out to Asia? Do you think the Gulf carriers need to do that? They're already signalling they're kind of okay. Do you think they're going to need to manage prices?
I suppose they will try to stimulate demand. Price is a tool that they can have.
When we get to the end of the summer, there's a possibility that a number of airlines are going to be struggling.
Yes.
Do you see an opportunity for M&A coming up?
We always say that this crisis can help to consolidation because we started this in a very good position with a very strong balance sheet, 15% of margin. So with the hedging, others they don't have all that. So at the end they are going to have problems. And what we want after this crisis is to be stronger, to show again that how resilient is IAG, and I am sure we can have opportunities, and we are going to.
Any targets you're looking at? Any areas that you're looking at? Would it be domestic Europe? Where were you looking?
No, I think you know that we tried, for example, to do the Europa operation before. It was not possible because of the European competition, and I think now Europe. They are trying to change the approach to consolidation, and maybe that can open the door again.
It's going to be easier to consolidate in Europe, you think, going forward?
I think they realize that after the Draghi report that we need to be more competitive, and we are not today. So I think if they have a different approach, maybe some operations that were not possible before can be possible now.
Any ideas of what that could look like?
No, I think...
Come on, Luis, there's got some names out there. Yes. What's on your shopping list?
We always have a department following opportunities. The International Airlines Group is a platform for consolidation. So it's our role to try to find out who can join the group, if we can improve the performance of that company with the model that we have.
And there are airlines in Europe that could fit that bill?
Yes. And I think a lot of airlines also, they would like to belong to IAG because of our model, that the different airlines, they have their brands, the customers, the network that we said before, so it's a model that is attractive.
Well, indeed, higher oil prices, pushing up jet fuel prices, putting pressure on the big airline names. That was the IAG CEO, Luis Gallego, speaking to Guy Johnson in Rio de Janeiro. But just a few terminal charts to set you up for the day ahead. And of course, as we think about the Middle East war, it has been depressing how much oil is coming out of the Middle East. We had that OPEC Plus meeting over the weekend, but you can see the lowest output since December 1985. That's represented by the white line here. But thanks to US exports, weaker Chinese demand, the strategic reserves being released, in fact, we haven't got the oil price where some had been warning it could be if the Strait of Hormuz were closed. We're not at the levels of $200 a barrel, $300 a barrel that some had warned. You can see it in the blue line, but let's flip the board because it's perhaps more pronounced on this next chart. The white line is WTI crude, and you can see it holding a level here, holding the floor. And yet the volatility when it comes to rates represented by the yellow, the pressure on the Fed to hike rates now, given the economic backdrop. And flip the board one more time. Of course, course, we had the US jobs data out of the US on Friday. Traders now fully pricing in a Fed hike before the end of the year. So Treasuries selling off, yields climbing, and that continuing today. Coming up here on Bloomberg TV, Francine Lacqua will be sitting down with the HSBC CEO, George Elderhary. That's later today at 7:30 a.m. UK time on the opening trade, which is coming up next. This is Bloomberg.